Open any trader's chart and you will see more than just candles. You will see extra lines, bands, and little graphs bolted on top and underneath. These are indicators, mathematical tools that chew on the price and spit out signals. There are hundreds of them, which terrifies beginners. But the truth is, traders rely on a small handful. So today, your 5 core indicators, what each one actually tells you, just like we did with the 5 numbers of value investing. A promise first, the same one as always. No single indicator is a magic button. Each is one opinion. The skill is letting a few of them agree before you trust the message. So let's collect your 5. Indicator 1, the foundation, the moving average. The price jumps around so wildly that the real trend can be hard to see. A moving average fixes that by averaging the price over a stretch of time and drawing it as one smooth, flowing line. The 2 most watched are the 50-day and the 200-day moving averages. The simple read, when the price is above its moving average, the trend is generally up. When it falls below, the trend is generally down. There is even a famous event called the Golden Cross, when the 50-day line crosses above the 200-day, seen as bullish, and its gloomy twin, the Death Cross, seen as bearish. A moving average is your trend, smooth. Indicator 2 you already met last episode, the RSI. It is the overbought and oversold gauge, a number from 0 to 100. Above 70, the stock is stretched and pricey. Below 30, it is beaten down and potentially cheap. The RSI tells you how stretched the rubber band is right now. Indicator 3, the momentum machine, the MACD. The name is a mouthful, moving average convergence divergence, but the idea is simple. It tracks whether a trend's momentum is speeding up or fading. It is drawn as 2 lines, and when they cross, traders read it as a possible shift in momentum, the trend gaining or losing steam. It was created by an analyst named Gerald Appel in the 1970s, and it remains one of the most popular momentum tools in the world. Indicator 4, the volatility envelope, Bollinger Bands. Invented by a trader named John Bollinger. These are 2 bands that wrap above and below the price, expanding when the market gets wild and squeezing tight when it goes calm. When the price rides the upper band, it is considered stretched high. When it sinks to the lower band, stretched low. And a famous Bollinger squeeze, when the bands pinch very tight, often warns that a big move is coming, though not which direction. Indicator 5 is one you already know, and it sits quietly under everything else. Volume. The bars showing how many shares traded. Volume is the conviction behind a move. A breakout on huge volume is trustworthy. The crowd is committed. A move on thin volume is suspicious. Whatever the other indicators say, volume tells you whether the market actually means it. So there is your toolkit. The moving average for the trend, the RSI for how stretched it is, the MACD for momentum, Bollinger Bands for volatility, and volume for conviction. 5 lenses, each answering a different question about the same price. Now the rules that separate a craftsman from a gambler. First, never act on one indicator alone. You wait for confluence, several of them telling the same story, a price above its moving average, with rising MACD momentum on strong volume. 1 signal is noise, 3 agreeing is a message. Second, and remember this from the charting episode, do not bury your chart under 20 indicators until you cannot see the price. A cluttered chart is a confused mind. Pick a few you understand and stop. And the deepest catch of all, the honest one. Every single indicator is calculated from the price itself. That means they all, by their very nature, lag. They describe what has already happened, dressed up to look like a prediction. They cannot truly see the future, because there is no future hidden inside past prices that the whole efficient market has not already seen. Indicators sharpen your read of the present. They do not hand you tomorrow. So should you, the long-term investor, drown in these? No. A patient index investor needs exactly none of them. But understanding the Big 5 means that when a trader breathlessly says a stock just had a golden cross with a bullish MACD crossover, you will know exactly what they mean and exactly how much faith to put in it. You can speak the language fluently and still choose the calmer path. So look back at that intimidating, cluttered trader screen we started with. It is not noise anymore. It is 5 honest tools, each measuring one thing, best used together and always with humility. The moving average, the RSI, the MACD, the Bollinger Bands, and volume. Learn those, and you can read almost any chart a trader throws at you. I'll see you in the next one. Until then, keep it simple and never trust a single line alone.